Welcome back to XRP Clarity, the channel where we cut through the noise and give you the real picture of what is happening in global finance and crypto markets. If you are new here, today is a great day to start paying attention, because what we are covering right now is not speculation. It is a convergence of events that does not happen often, and understanding it could genuinely change the way you see your financial position going forward. Before we get into everything, I want to flag something that is unfolding this week. Something that ties directly into every single topic we are about to walk through together. The CME Group is launching around-the-clock XRP futures trading beginning May 29th. At almost the exact same moment, the Federal Reserve is preparing to inject $7 billion into the economy. Two major events. Same narrow window of time. And I want to be very clear with you right now. That is not a coincidence. I am going to show you exactly why these two events are connected, what they mean together, and why the timing matters more than most people currently realize. Before we move on, had you heard about either of these developments before clicking on this video today? Drop a yes or a no in the comments right now. I genuinely want to know. And just to be transparent, as always, nothing in this video is financial advice. This content is strictly for educational and informational purposes. Please do your own research before making any financial decisions. Voice. CME explained. Let us start with the CME announcement, because this is the piece that most people scrolled past too quickly this week. And that is a mistake. CME stands for the Chicago Mercantile Exchange. And if that name does not immediately mean something to you, let me give you a sense of the scale we are talking about. This is one of the most heavily regulated financial marketplaces operating anywhere in the world today. Pension funds use it. Hedge funds use it. Major commercial banks use it. Insurance companies use it. Sovereign wealth funds, the investment vehicles that manage the national reserves of entire countries, use it. This is not a retail crypto exchange where everyday traders are buying and selling coins from their phones. This is institutional infrastructure. It is the kind of platform that the world's largest pools of managed capital rely on, and in many cases are legally required to use when they want exposure to a financial instrument. When the CME decides to list a new product, that decision carries a very specific message to the managers of hundreds of billions of dollars in capital. The message is this: this asset now has a home that meets your compliance requirements. That is not a small signal. That is an open door into a room that was previously closed. Voice. What futures contracts actually mean on May 29th? The CME opens that door for XRP through 24/7 futures contracts. To understand why that matters as much as it does, you need to understand two things clearly: what a futures contract actually is, and why the 24/7 structure specifically changes the game. A futures contract is a legally binding agreement to buy or sell an asset at a predetermined price on a specific future date. When a major institution enters an XRP futures position on the CME, they are not necessarily going out and purchasing XRP tokens directly. What they are doing is expressing a market position through a regulated, exchange-listed instrument. And that distinction is genuinely important, because many of the institutions we are talking about, pension funds, large asset managers, banks operating under specific regulatory frameworks, face real legal or internal policy restrictions on directly owning cryptocurrency. But they can frequently access regulated derivatives products. A CME-listed futures contract is exactly that kind of product. It is the financial bridge that connects enormous pools of institutional capital to XRP exposure without requiring those institutions to step outside their compliance boundaries. That bridge did not exist before. Starting May 29th, it does. Voice. Why 24/7? Is the real game changer now. The 24/7 trading structure is not just a footnote in this story. It is actually the piece that removes the most persistent and frustrating friction point between institutional capital and crypto markets. And that friction has been a real operational problem for years. Here is the issue. Traditional financial markets close. They close on weekends. They close on holidays. They close outside of normal business hours. Crypto does not. Crypto trades every hour of every day without interruption, without pause, without closing bells. That gap has created a serious operational headache for institutions. Think about what it actually means in practice. A fund holds a futures position on an exchange that closes Friday afternoon. Over the weekend, a major global event happens. Geopolitical news, a central bank announcement, a regulatory decision, something that moves markets. That fund has zero ability to respond. They carry their exposure blind through Saturday and Sunday, unable to manage risk until Monday morning. The CME's 24/7 structure eliminates that problem entirely. Institutions can now manage their XRP positions the same way XRP actually trades in the real world. That is a meaningful structural change, and it fundamentally alters who can participate in XRP price discovery going forward. Voice. The Federal Reserve and global liquidity. Now let us talk about what the Federal Reserve is doing and why it connects directly to everything we just covered. The Fed is preparing to inject $7 billion into the economy in the coming days. But here's the part that most headlines are leaving out. That $7 billion figure is described as the beginning of a broader and sustained liquidity expansion, and it is not just the United States moving in this direction. Europe is doing the same. China is doing the same. Multiple major economies are all expanding liquidity simultaneously, and that synchronized movement has very specific historical implications for crypto markets. To understand why, you need to understand what M2 is and what it actually tells us. M2 is a measure of the total amount of money circulating in an economy: cash, checking account balances, savings deposits, and certain short-term accounts. When M2 rises, more capital is available for investment, and that capital flows outward through the financial system, eventually reaching financial assets of all kinds. The asset class that the data shows responding most strongly and most consistently to rising global M2 is not real estate, not commodities, not bonds. It is crypto. That is not a theory. That is a pattern drawn from multiple cycles of real market data. Voice. The M2 numbers and what they project, the current numbers make this even more relevant. Recent year-over-year M2 growth has been running at approximately 4.5 to 4.7%. Over the next 12 months, that growth is projected to continue in a range of 4 to 6%. The global money supply is expanding, and the data suggests it is expected to keep expanding. When you hold that fact next to what we know about how crypto markets have historically responded to rising global M2, everything else happening this week starts connecting into a single coherent picture. The CME opening institutional access. The Fed beginning a liquidity injection, Europe and China moving in the same direction. These are not isolated events. They are pieces of the same larger economic shift, and they are all arriving at the same time. This is the context in which Senator Cynthia Lummis stood before the major U.S. banks and told them plainly that adapting to this new financial landscape is not optional. It is a matter of survival. That was not rhetorical flourish. She was describing something she could see clearly in the data. The same data we are walking through together right now. Voice. JP Morgan, Visa, Mastercard. The pilots are real. Here is another piece of this picture that deserves far more attention than it has received in mainstream coverage. JP Morgan and other major U.S. financial institutions are running active XRP pilot programs right now. Visa and Mastercard are doing the same. All of them are working with Ripple, either through its stablecoin or directly through the XRP ledger. Now I want to be very precise about the language here, because the word pilot can sometimes make things sound more tentative than they actually are. These are not exploratory conversations happening over coffee. These are not internal memos floating around a boardroom. These are structured operational tests being run by institutions that collectively process some of the largest transaction volumes on the entire planet. When JP Morgan runs an XRP pilot, they are not testing whether blockchain is an interesting concept. They are stress testing a system they are seriously considering deploying at institutional scale. That is a completely different level of commitment, and it matters enormously for understanding where this is heading. Voice. Why the price hasn't moved yet. The lag. This brings us to the question that is probably sitting in the back of your mind right now, and it is the most important one for anyone following this thesis. If the money supply is expanding, the CME is opening institutional access, and the largest banks are already testing XRP, why has none of this shown up clearly in the price yet? And when does it actually reach the market? The answer is something called the lag, and it is one of the most consistently misunderstood dynamics in all of crypto market analysis. Understanding it correctly will change the way you read everything that is happening right now. When central banks expand the money supply, that money does not flow immediately into crypto. It moves through the financial system in stages, following a predictable path from the least risky asset classes toward the most risky. Government bonds absorb it first, then large cap equities, then riskier categories, then eventually crypto. That process takes time. Historically, it takes approximately 3 months from when the money expansion begins to when its effects actually show up in crypto prices. 3 months can feel like an eternity in a market that moves the way crypto moves, and that lag period is exactly when the most counterproductive investor decisions tend to happen. Voice. The 2020 cycle. The pattern. We've seen before. The clearest recent evidence of this lag playing out in real time is the 2020 cycle, and it is worth walking through carefully because the parallel to today is direct. When quantitative easing, large-scale money injection by central banks, began at significant scale in 2020, crypto did not immediately rally. It corrected first. The pullback was real, it was sharp. It was uncomfortable for anyone holding positions at the time. People who did not understand the mechanism looked at that correction and saw confirmation that the thesis was wrong. What they were actually looking at was the lag in progress, the normal sequence playing out exactly as the data would have predicted. What followed that correction were explosive new all-time highs across the crypto market. The pattern was visible in the data the entire time, but it required a framework and genuine patience to read correctly while you were living through it. We appear to be at the beginning of a new expansion cycle right now. The $7 billion Federal Reserve injection is described as the opening move, not the complete picture. Europe and China are adding liquidity at the same time. If the 3-month lag holds as it has historically, the current moment may not be where prices immediately surge, it may actually be where prices first pull back before the broader rally the expansion eventually produces.